You think everyone who owns a piece of a 200-unit apartment complex inherited it? That's the assumption sitting underneath almost every scroll past you've ever done, every headline about billion-dollar real estate empires. You picture a boardroom, a trust fund, a last name that opens doors before a handshake ever does. Then you meet a guy named Marcus at a barbecue in a stranger's backyard, holding a beer he's barely touched, telling you he owns 4% of a 48-unit building in Tucson he's never even flown out to see. He's 29. He works in medical device sales. He put in $35,000 18 months ago and now gets a wire transfer every quarter that's bigger than his old rent payment. You almost ask if he's lying. He shows you the K-1 tax form on his phone instead, like it's a photo of his kid. That's the moment the whole myth cracks open for you. Syndication was never a rich person's game reserved for people who already had 8 zeros. It's just pooled money. That's it. That's the entire secret hiding behind words like sponsor and capital stack and preferred return. One person finds a deal too big to buy alone, so they go find other people willing to chip in, and everyone owns a slice of something none of them could have swung solo. 100 strangers can own a shopping center together and never once be in the same room. You've been walking past this idea your whole life thinking it needed a different last name than yours. So you start where almost everyone starts, at level 1, as what's called a limited partner. An LP, the passive money. You're not finding the deal, you're not underwriting the numbers, you're not the one on the phone with contractors at 7 a.m. You're the check. Marcus is the check for that Tucson building, one of maybe 30 checks that got written to raise the $2.1 million equity that building needed. Your money buys equity, meaning ownership, meaning you now own a real legal fraction of a real, physical building sitting on real dirt in a city you may never visit. You put in somewhere between $25,000 and $50,000, sign a subscription agreement that's longer than your last apartment lease, and then you wait. That's the whole job at level 1, waiting and depositing the distribution checks that show up on a schedule you didn't set. This is where almost everyone's syndication story starts, and where a lot of people's stories quietly end, content to just be the money forever. There's nothing wrong with that. Marcus is fine with that. But you're not Marcus. You start going to the calls other LPs skip, asking the sponsor questions that make him pause before answering, and about 8 months in, you catch yourself thinking the thing every future GP thinks right before they can't unthink it anymore. I could probably run one of these. That thought is level 2, and level 2 is where the training wheels come off completely. Level 2 is you, for the first time, as the general partner. The GP, the one whose name is on the deal, whose phone rings when a pipe bursts, who has to look 20 strangers in the eye, sometimes literally, and convince them to wire 5 figures each into a duplex or a 12-unit walk-up you found on a slow Tuesday scrolling listings you weren't even sure you were allowed to look at yet. Here's the structure, stripped all the way down. As the GP, you find the deal, you underwrite it, meaning you build out the spreadsheet that says this building bought at this price, with this much renovation, rented at these new rates, makes this much money. You sign on the loan, usually with a partner or two, because most lenders won't hand a first-timer $1.4 million a loan. And you go raise the equity, the cash gap between what the bank will lend and what the seller wants, from LPs like the version of you that existed 8 months earlier. In exchange for doing all the work, taking all the liability, losing all the sleep, GPs typically keep somewhere around 20–30% of the ownership for free, sometimes called the promote, on top of whatever cash they personally put in. The LPs split the rest of the equity based on how much they invested and usually get paid first, a preferred return, often 7–8% annually, before the GP touches a dollar of profit beyond fees. It's not complicated once you see it laid out. It's just unfamiliar the first time you're the one drawing the lines instead of reading them. Your first deal is a 6-unit building 2 towns over from where you grew up, bought for $780,000, needing $60,000 in cosmetic renovation you're doing yourself on weekends because you can't afford not to. You raised $210,000 from 9 people, 4 of them family, 1 of them Marcus, who says yes before you even finish the sentence because he remembers what it felt like to be the first check someone else believed in. And this is where it gets hard in ways the podcast never mention. You underraised by $18,000 because you forgot to build in a contingency line for the roof section nobody flagged during inspection, and you spent 3 weeks in June making calls you'd rather not make, asking people who already said yes once to say yes again. Your underwriting on Unit 4's rent bump was optimistic by $150 a month, and optimistic is a generous word for what it actually was. You go quiet on investor updates for 5 weeks during the renovation because you're exhausted, and you learn the hard way that silence reads as disaster to someone who just wired you $25,000, even when nothing is actually wrong. Your uncle texts you at 11 p.m. asking if everything's okay. Everything's fine. You just forgot that being trusted with money means the update matters more than the update having anything new in it. These are the 3 mistakes that kill more first syndications than bad markets ever will. Underraising because you underestimate what things actually cost. Weak underwriting because you want the deal to work more than you've confirmed that it does. And silence because you think numbers speak for themselves when what your investors actually bought into was you. None of it breaks you though. 18 months later, that 6 unit is cash flowing $3,400 a month above expenses. You've refinanced out $95,000 in equity to return to your investors early, and Marcus has already asked if he can put double into whatever you find next. That's the thing nobody tells you about the first deal. It's not actually about the 6 units or the $210,000 or even the spreadsheet. It's about becoming someone that 9 people, then maybe 90 people, then maybe 900, will eventually trust with a wire transfer sight unseen. Every dollar you ever raise again traces back to whether those first 9 people got their money and their update on time. You didn't need a trust fund. You needed a duplex-sized mistake you were willing to survive in public in front of the people who bet on you first. 2 years after that 6 unit closes, you're sitting in a rented conference room in a co-working space, and there are 11 people in the room who are not your uncle. Not Marcus either, though he's on the call from a hotel lobby in Denver, muted, nodding along to slides he's seen versions of 3 times now, because you've started doing this for a living. This is deal number 5. A 34-unit value-add property in a mid-sized Texas market you picked because the job growth numbers made sense on a spreadsheet before they ever made sense to your gut. And somewhere in the last 18 months, without you fully clocking the moment it happened, you stopped being a guy who did one deal and became something else entirely. You became an operator with a pipeline. That's level 3, and level 3 is less about any single building and more about the machine you build around the buildings. 3 to 10 properties, sometimes all at once, sometimes staggered a few months apart, and the thing that separates you from the version of yourself 2 years ago isn't confidence, it's repeatability. Your first deal, you built a subscription agreement from a template you found at midnight and prayed a lawyer friend would look over for free. By deal 3, you have a standardized PPM, a private placement memorandum, that your attorney can turn around in 4 days instead of 4 weeks because 90% of it never changes. You have an investor pipeline now instead of a group text. A real CRM with 140 names in it, tagged by check size, tagged by which asset class they liked last time, tagged by whether they open your emails or let them sit. You have a one-pager for every new deal that goes out to that list within 48 hours of you putting a property under contract because you learned by deal 2 that the first Saturday morning email gets 3 times the response of the Tuesday afternoon one, and at this level, timing your capital raise is its own skill sitting right next to underwriting. This is also where the marketing starts feeling less like begging and more like a business function. You're not calling your uncle at midnight anymore. You're sending a Loom video walkthrough of the property to 140 people, hosting a live Zoom Q&A where 9 of them show up, and watching soft commits roll in on a spreadsheet before you've even finished the inspection period. The $210,000 raise that took you 3 stressed-out weeks on deal 1 now happens in 9 days for a $1.4 million raise on deal 5, not because the number's smaller relative to you, but because the process finally has muscle memory. Standardized docs, a warm list, a repeatable marketing cadence. That's the whole unlock of level 3. You stop reinventing the raise every single time. Level 4 is where the checks themselves change shape. You're no longer raising from people who write $25,000 in hope. You're raising from people who write $250,000 without blinking, because somewhere along the way you crossed into rooms with accredited investor networks, small family investment clubs, syndicated capital groups where 20 people who've never met you personally will still wire 6 figures because someone they trust vouched for your track record over dinner. Your typical raise per deal jumps from that first $210,000 to somewhere between $3 million and $8 million, and the individual check sizes jump right along with it. $1 million here from a physician group in Charlotte pooling 4 members together, $2.5 million there from a small fund that specializes in nothing but multifamily and Sunbelt secondary markets. You're still doing plenty of the retail-sized checks too, the $50,000 and $100,000 wires from people like the earlier version of Marcus, but now they're sitting in the same capital stack as institutional adjacent money, and you have to learn fast that those 2 types of investors want almost opposite things from you. The retail investor wants a warm relationship and a monthly update with photos of the leasing office. The fund manager wants a quarterly reporting package that looks like it was built by someone who's read an audited financial statement before. That tension is exactly what pulls you into level 5, because the fund managers you've been impressing eventually introduce you to the people above them. Private equity shops looking to deploy $20 million a year into operators they don't have to hold hands with. Family offices, the quiet kind, the Ellery kind, sitting on generational money that needs a home in real assets and doesn't care about your Instagram at all, only your track record and your ability to close on time. This is the first moment institutional capital sits in the same deal, same capital stack as retail investors who found you through a podcast interview or a friend's referral. And it changes how you build every single deal after, because institutional money asks questions retail money never thought to ask. What's your insurance captive structure? What's your interest rate cap cost built into the pro forma? What happens to this deal if cap rates move 75 basis points against you at exit? You start answering questions you didn't know existed 2 years ago, and you start getting better at the job because of it, not despite it. The fee structure evolves right alongside the capital, and this is the part nobody explained to you back at the 6 unit, because at that size there was barely a structure worth naming. Now, on a $9 million acquisition, you're collecting an acquisition fee, typically 1% to 2% of purchase price, paid at closing for the work of finding, underwriting, and closing the deal, so somewhere between $90,000 and $180,000 the day you sign. You're collecting an asset management fee, usually 1% to 2% of gross revenue annually, paid out for the years of operations, the calls with the property manager, the decisions about whether to replace the roof this year or push it to next. And then there's the promote, the carry, the piece that made you want to do this in the first place, structured now in tiers, maybe 70-30 split with investors up to an 8% preferred return, then 60-40 above that, then 50-50 above a second hurdle. So the better the deal performs, the more of the upside actually lands in your pocket instead of sitting flat the way it did on deal 1. And somewhere in the middle of building all of this, you stop thinking like an operator and start thinking like a business builder, which is a different job entirely. An operator asks whether this one deal pencils. A business builder asks whether the portfolio is diversified enough that one bad market or one bad asset class doesn't take the whole thing down with it, which is why your 5 properties aren't all Texas multifamily anymore. There's a self-storage facility in Ohio, a small medical office building in Nashville, a value-add apartment complex in Florida, spread across 3 property types and 3 regions specifically so a single hurricane, a single oversupplied submarket, a single interest rate shock can't wipe out everything you've spent 3 years building. You didn't used to think about correlation risk, now it's the first thing you model before you model the returns. That shift, from loving the deal in front of you to protecting the 20 deals behind it, is the real marker that you've left level 3 behind for good. By the time you're closing deal 12, something breaks in the old model, and it breaks in a good way. You're sitting across from your attorney explaining that you have 3 deals in the pipeline simultaneously, a 62-unit in Phoenix, a 140-unit in Charlotte, and a small industrial park outside Columbus, and she stops you mid-sentence and asks why you're still doing 3 separate PPMs, 3 separate subscription agreements, 3 separate capital raises with 3 separate closing timelines when you could be raising once into a vehicle that buys all 3. That question is the exact doorway into level 6, and once you walk through it, you never go back to raising deal by deal again. A fund structure sounds like a technical upgrade, but what it actually does is change the entire physics of how you raise money. Instead of going back to your list of 400 investors every 4 months with a new one-pager and a new 90-day closing window, you raise once, say $40 million into a blind pool fund with a defined investment thesis, Sunbelt multifamily and light industrial, value add, 3 to 5 year hold, and then you deploy that capital across however many deals fit the thesis over the fund's life. Your investors aren't underwriting one property anymore. They're underwriting you, your judgment, your track record across the 11 deals that came before this fund even existed. That's a different kind of trust, and it's worth noticing that it took you 3 years of proving yourself deal by deal to earn the right to ask for it. The first time someone wires $500,000 into a fund where you haven't even identified the 3rd or 4th asset yet, it lands different in your stomach than any check before it. That's not an investor betting on a building. That's an investor betting on you. The numbers shift in a way that would have sounded made up back at deal 1. Your typical raise per vehicle jumps from the $3 to $8 million range you were doing at level 4 to $25 to $75 million per fund, sometimes more, and because you're not restarting the legal and marketing machinery every single time, your cost of capital actually drops even as the total dollars raised explodes upward. You're paying your fund admin fee, your legal fee, your audit fee once a year instead of once a deal, and that efficiency alone is worth low seven figures across a fund's life that you use to bleed away in duplicated paperwork. But raising bigger money exposes a problem fast, and it's the same problem every operator hits right around $100 million in assets under management. You cannot personally underwrite, personally manage, and personally answer every investor email for 40 properties spread across 9 markets. This is level 7, and level 7 is less glamorous than the fund headline, but it's the part that actually determines whether you survive at this size. You build an acquisitions team, 3 or 4 analysts whose entire job is sourcing and underwriting deals before they ever hit your desk, so that instead of you personally reviewing 200 broker emails a week, you're reviewing the 6 that survived a filter built by people you trained. You build a dedicated asset management team, property-level reporting rolling up into portfolio-level dashboards, so you know within an hour if occupancy at the Phoenix asset dips below 91% instead of finding out at the quarterly call 3 months late. And you build out compliance and legal infrastructure that would have sounded absurd to the version of you closing that 6-unit off a template PPM, in-house counsel, or a dedicated outside firm on retainer, a compliance officer making sure every fund filing, every Reg D exemption, every state blue sky requirement is airtight, because at this size a single filing mistake isn't a slap on the wrist, it's a regulatory problem that can freeze capital for months. This is also where you stop being the smartest person underwriting every deal and start being the person who built the room where smarter underwriting happens without you in it. That's a hard transition for anyone who fell in love with spreadsheets and site visits, and plenty of operators stall out right here because they can't let go of the deal level control that got them this far. The ones who break through level 7 are the ones who realize their actual job changed from operator to architect somewhere around deal 20, and they stopped fighting it. Level 8 is where the number stops sounding like a real estate portfolio and starts sounding like a headline. $1 billion in assets under management doesn't happen through Fund 3 or Fund 4 alone, not usually. It happens because you've built enough of a track record, enough audited performance history, enough institutional grade reporting that the biggest pools of capital on earth start looking at you the way you once looked at a broker with a good deal. Pension funds managing retirement money for entire state workforces start doing joint ventures with your platform, contributing $150 million alongside your $50 million because they need real estate exposure and they've decided your operational infrastructure can be trusted with it. Some operators at this level launch a REIT, a real estate investment trust, taking the whole portfolio public or quasi-public so shares trade and capital comes in through markets instead of one-on-one investor relationships. Others stay private but start syndicating joint ventures with insurance companies and sovereign wealth funds. The kind of capital that moves in checks of $80 to $200 million and doesn't blink. And here's the part that actually explains why the biggest players scale so much faster than the math would suggest they should. It isn't just that they raise bigger checks, it's leverage, refinancing, and cap rate arbitrage working together like a flywheel. You buy a $60 million asset at a 6% cap rate using 65% leverage, force appreciation through renovations and better management over 3 years, and refinance at a lower cap rate environment, pulling out $18 million in tax-free cash through a cash-out refi while you still own the asset outright. That $18 million doesn't come from selling anything. It becomes the down payment on the next $70 million acquisition, and now you own 2 assets on capital that originally bought one. Do that 6 or 7 times across a portfolio and the AUM number compounds in a way that looks almost unfair from the outside, because it is, in the sense that it's only available to people who've already built a track record and infrastructure to execute it cleanly. And that track record is the real asset at this level more than any single building. Your reputation starts doing work your marketing budget used to do. Brokers bring you off-market deals before they ever hit a listing service because they know you close. Investors from 3 funds ago call you before you've even announced the next one. Capital moves toward you at a velocity that has nothing to do with cold outreach and everything to do with 15 years of doing exactly what you said you'd do, deal after deal, fund after fund. That's the compounding effect nobody puts in the pitch deck. Money doesn't just grow at this level, trust grows, and trust is what lets the money move faster than it ever could before. So look back at the whole ladder for a second because it's worth seeing the shape of it all at once. Level 1 and 2, your first deal, a handful of investors, a 6-unit that terrified you into learning fast. Level 3 through 5, the machine, standardized documents, bigger checks, institutional capital sitting alongside retail money in the same stack. Level 6 through 8, funds instead of single deals, teams instead of one person underwriting everything alone, and eventually pension money, REITs, and $1 billion in assets built on leverage, refinancing, and a reputation that took over a decade to earn. Here's what nobody tells you on the way up, though. The single most expensive mistake in this entire ladder isn't a bad market or a bad tenant. It's a misaligned fee structure or a badly written LP agreement signed back at level 2 or 3 that quietly costs you control or costs your investors trust years before you ever notice the damage. I break down exactly what that mistake looks like and how to avoid it in the book linked in the description below.